Updated the 7th of December 2017, 2245 AEDT. The recently released Paradise Papers have again turned the media spotlight on small tax havens. The only difference from last year's Panama Papers is that the contracts leaked to the public are from a respectable law firm in Bermuda Appleby, and not from a suspicious and less-known firm in Panama Mossack Fonseca. Otherwise, the key message is the same: individuals and firms use the services of tax havens to avoid paying taxes in their own countries. Appleby's media response was swift and clear: there is nothing illegal in their actions. In short, Appleby uses tax law loopholes that allow individuals and firms to transfer their wealth in countries where taxation is zero. The immediate reaction by some was that we should regulate and close these loopholes. That is the traditional regulatory way of dealing with distortions. Economists, however, tend to believe in the power of incentives, and the invisible hand of markets closing down existent tax havens and loopholes will only open new ones somewhere else in the system. As long as there is demand for such services, the supply of these services will take place. Cracking down on small islands that offer tax services may even have unwanted side effects. Why? Let us explain. Tax havens curb competition among nations. Own argument gaining credence is that the existence of small island tax havens makes it less attractive for larger countries to engage in tax competition. The widespread use of tax havens alleviates what would otherwise be aggressive competition between big countries to reduce taxes as a way of attracting and maintaining real investment. Such real investments matter for big countries as, for example, they create jobs where people live. When firms are able to shift their profits to low-tax jurisdictions through financial transactions, for example, thin capitalization, the location choices for real investments become less responsive to tax rate differentials. Hence, closing down tax haven islands, without removing the demand for their services, may shift tax competition among large countries with even more adverse effects for the world economy. Such arguments are part of a new literature on tax havens that tries to make sense of the empirical data that show the high demand by global firms for tax haven services. The above issues arise only because profits are taxed in the country where they are reported, but not necessarily generated. Reporting high profits in, say, the Bermuda subsidiary of a multinational firm and low profits in, say, the Australian headquarters is legal as long as the methods used to shift profits are following the rules that each country has. Here is where the Big Four accounting firms have their expertise in advising global firms. This separate accounting method of taxing firms is the basis of our current international taxing system. It was agreed back in 1926 under the auspices of the League of Nations, and almost 100 years later, nothing has changed, despite globalization. Any viable solution to the broader issues around profit shifting, and thereby tax havens, will need to focus on taxing profits in the country where they are actually generated. This calls for activity-based taxation for firms. GST-style tax on firms might work to grasp the difference between income-based and activity-based taxation. Think about consumption taxes such as Australia's GST. They tax the goods that you buy and not the income that you have for buying these goods. The logic behind this is that income is fungible, whereas consumption is tangible. While there are many ways of defining income, the purchase of a Mercedes-Benz is less disputable. The success of consumption taxes in raising government tax revenues worldwide is phenomenal. Indeed, consumption taxes are now a standard instrument in setting up sustainable tax revenue in countries where tax avoidance evasion is large. Applying the same logic to firms makes sense. How should we implement activity-based taxation on firms? This is, of course, not an easy task. A proposal that was entertained at the League of Nations negotiations in 1926 but not chosen was formula apportionment. Under this proposal, a firm's consolidated global profit is split among nations based on what activity the firm has in each of these nations, and then taxed. For example, if Apple makes 40% of its profits by selling its products to U.S. consumers, then U.S. tax authorities should tax 40% of Apple's global profits. This is currently the system that operates within most federal countries in the world, where member states, U.S. provinces, Canada, Canton, Switzerland, or Länders, Germany have the right to impose their own taxes on firms. While a federation, Australia's states are not allowed to tax separately firms' corporate income. The European Union is currently working on such a taxation system as an attempt to stop the profit shifting that takes place between EU countries. What constitutes activity of a firm in a country can of course be many things. While formula apportionment is possible in federations, it needs a high level of coordination to be implemented at an international level. One could easily imagine that those countries benefiting from our current international taxation system will oppose any change to a new system that will cost them trillions of dollars. A global institution like WTO can be of help here, but this will take time. Make cash flow king, and tax site radical unilateral i.e. by single countries reforms can be a more immediate alternative. The U.S. Republican Party proposed a destination-based cash flow tax system in January this year, which created a lot of traction in policy debates. Here, it is not profits that are taxed but revenues minus labor costs, i.e. cash flow. While not a panacea to our problems, it is surely a proposal that is worthy of further investigation. So, to answer the question put forward in our title, is everything about tax havens bad? On balance, the answer is no. Tax havens, operating within a world of tax competition and profit shifting, may help avoid greater harm. Professor Pascalis Raimondos is head of the QUT School of Economics, and Sarah L. McGahey is professor of international business at Griffith University.